Many business owners think tax planning happens only in June when your corporate tax return is due. But in reality, tax planning is a year-round process with some big savings often available at year's end. I'm Paul Barreca, Certified Financial Planner at West End Wealth Planning, IPC Securities Corporation. Before the year wraps up, there are a handful of smart corporate tax moves you might want to consider, especially if your income or investment situation has changed this year. Let me walk you through a few smart moves to consider before year's end. First, if the profitability of your operating company is down this year, it might be a good time to consider triggering some capital gains inside your corporate investment portfolio while you're in a lower tax bracket. Second, if you're planning to pay yourself a bonus, you might want to delay until January. That gives you more flexibility for next year's planning. Third, if you've earned more than $50,000 in passive income within your corporation, that will put your business over the small business tax deduction. So you'll want to consider the following: either repositioning your corporate passive portfolio to reduce interest and dividend income, as well as repositioning assets to create more deferred capital gains in the future. It may also be worthwhile to look into corporately owned insurance strategies that grow very tax efficiently and provide tremendous estate tax efficiencies. Fourth, speaking of the capital dividend account, if you had tax-free capital gains this year, this might be a good time to distribute a capital dividend to yourself before year's end. Just make sure you file the right election paperwork. Fifth, review how you're compensating yourself. Does it make sense to pay salary or dividends this year? Salary gives your corporation a deduction and builds RRSP room for 2026. But if you're around age 60 and you've been paying Canada Pension Plan contributions since your early 20s, dividends might be the better solution, since making additional CPP contributions may provide little or no additional pension benefits. And finally, the basics still matter. Make sure you paid all of your outstanding expenses prior to December 31st, and double check that tax installments are up to date, both personal and corporate, to avoid non-deductible interest and penalties. There's no one-size-fits-all tax plan, but when you act early and plan smart, year-end becomes a real opportunity, not just another accounting deadline. Now, if you want more strategies to protect your capital, then you'll be interested in our fantastic new report, 9 Tax and Retirement Strategies Every Business Owner Needs to Know. Our guide includes the most tax-efficient retirement strategies for business owners, paying your family's health and dental expenses using deductible corporate dollars, and so much more. Just click the link in the show notes or scan the QR code on the screen to download it now. And for weekly insights grounded in reality, not trends and buzzwords, subscribe to our channel on YouTube, follow us on Facebook and Instagram, and connect with me directly on LinkedIn. We'll keep you up to date with professional advice that you can trust. Thanks for watching, and I hope we see you next time.